Today, we are going to be covering a stock in the mergers and acquisitions space. On one hand, you have Brookfield's Bruce Flott, whose acquisitions has positioned Brookfield as a leader in AI infrastructure. On the other hand, you have Kathy Wood of ARK Invest, whose capital allocations the past 5 years has resulted in near 0% returns. She is the symbol of an M&A philosophy where speculative growth trumps value. But what if you could blend Bruce Flott's relentless discipline with a disruptive, relentless hunger for scale and innovation? This brings us to the GOAT of M&A, Brad Jacobs. Jacobs hasn't built just one multi-billion-dollar company. He's done it 8 times. With over 500 acquisitions to his name, he targets fragmented, asset-heavy industries like logistics, equipment rentals, and waste management, and then integrates them together to create a dominant market leader. Today, we will break down QXO, Brad Jacobs' newest venture and his biggest to date, a targeted $50 billion revenue business in the building products industry. Rather than retire, Brad Jacobs decided to put $1 billion of his own money into starting QXO with the mission to consolidate this $800 billion industry spend that is spread among 7,000 distributors in North America. Many of these smaller distributors also are in desperate need of technological implementation to improve their customer experience and ultimately improve operating efficiency. There are also strong secular tailwinds that will drive continued growth in this segment as well. Well known as a massive 4 million home shortage in the United States, so eventually new homes will need to be built and that will be accelerated. In the meantime, we have an aged home issue with 60% of homes over 40 years of age and in desperate need of repair and remodeling. Lastly, outside of residential home building, the U.S. government projects that we'll need to spend $2 trillion in infrastructure upgrades over the next 2 decades. Long story short, lots of construction spend in the years ahead. Currently, QXO has succeeded in making its first acquisition of Beacon Roof and Supply, having paid roughly $11 billion for the business at roughly a 1.2 price to sales multiple. Let's now look at what Brad Jacobs plans to do with Beacon Supply to improve its valuation, which will demonstrate his playbook for all his acquisitions. The best part of QXO's playbook is that it does not depend on the synergistic benefits that many companies like Kraft Heinz will claim. Rather, it focuses on improving the business operations itself to lead to sustainable earnings and revenue growth. The target that QXO is aiming for with their Beacon Supply acquisition is to double its EBITDA. The key theme for how Brad Jacobs executes transformation is through a smart introduction of technology into old stagnant businesses that did not stay up to date on the latest tech. It worked for United Rentals, and it worked for XPO, and chances are it will work for QXO. To grow revenue, he will implement technology to better analyze price elasticity by SKU to maximize the price that he can charge. Customers would be willing to pay more since he aims to dramatically improve customer service by ensuring the right product is available and can be serviced immediately in full. This is Supply Chain 101, but implemented in ERP system is critical, especially in ensuring that the 20% of SKUs making 80% of sales are always in stock, no matter what. For earnings, it comes down to reducing the cost to serve an order. A key factor of that cost is transportation cost. So optimizing Beacon's warehouses to have the right product at the right warehouse will minimize transportation costs of roof and supply, which are very bulky items. Don't forget too that Brad Jacobs built XPO into the world's most advanced automated warehouse on par with Amazon's, so he can also bring that know-how to optimize warehouse processes where it makes sense at QXO. Overall, by implementing technologies in a stodgy business like Beacon, he can, and I believe will, succeed in doubling EBITDA and doubling net margins from 5% to 10%. Now, imagine him doing this for every business he acquires for QXO, not just Beacon Supply. And now it makes sense how his previous ventures have outperformed. I just really like that Brad Jacobs focuses on improving the business versus just a playbook out of Brian Nichols' playbook and cutting labor costs fast, which rarely brings long-term results. We're seeing this now with Chipotle. A key watchout often mentioned for QXO is what if Brad Jacobs cannot acquire more businesses and is stuck with just Beacon Supply. He did, after all, get outbid by Home Depot for GMS recently. To me, I actually see the GMS outbid as a positive, as it does reemphasize Jacobs' value approach to not overpay. Home Depot will outbid QXO anytime they want because they're just much larger, but the total market of distributors is 7,000 in North America and Western Europe, which is such a large number that I believe both Home Depot, Lowe's, and QXO can all coexist and scoop up acquisitions. Now let's look at a bear case for QXO. Let's assume even though Brad Jacobs has completed over 500 acquisitions in his 40-year career, that he cannot do any more at all, and QXO is just Beacon Supply. From a revenue run rate, Beacon is at a $9.8 billion run rate in 2024. Let's be conservative and assume revenue growth is an average of 5% a year through 2030. This is conservative as Beacon has been resilient through economic cycles since most of their business is non-discretionary repairs. Severe weather events have quadrupled over the last 20 years, and 60% of homes are over 40 years of age and in need of repair. Anyways, 5% revenue growth annually gives us a 2030 revenue of $12.8 billion. For net margin, in 2024, Beacon had a 5% net margin rate. Now, if there's one thing I know about Brad Jacobs, is that when he sets a target, he meets it. So I will take him for his word that he will increase net margins by 500 basis points, so 10% net margin rates. For PE, their comparable is with Builders First Source, which trades at a 16 PE today. The standard 15 PE seems quite fair for a business with 10% net margins and growing revenue at a low single-digit rate. So putting all this together, and in the bear case, QXO has a $19 billion market cap for 2030, much higher than today's $12 billion market cap. In a bull case scenario for QXO, let's assume they are at a $25 billion revenue run rate. This is half of the $50 billion target Brad Jacobs set to be at in the next decade. This would mean several more big acquisitions. The average net profit margin for the building products distribution is 6.6%. With Brad's technological implementations, let's assume he can improve those margins by 25% to 8.2%. For PE ratio, XPO and United Rentals both have traded at PE premiums due to its perceived status as a high-growth, technology-forward industrial consolidator, with higher growth than competitors and with predictable and durable free cash flow. That's a staple for a Brad Jacobs business. Now, putting all this together, this gives QXO a 2030 bull case of $51 billion, a 4x stock price from here. Both bear and bull case for 2030 valuation for QXO would be great returns for our portfolio. Now, before we run through our framework to determine if we will be buying QXO, please read the disclaimer in the notes below. We are not financial advisors, and anything we say should not be taken as financial advice. Also, if you like content like this, please help us out and click a like and subscribe as we aim to analyze the most innovative companies twice per week. Now let's put QXO through our framework. From a leadership perspective, it should come as no surprise, since I've said Brad Jacobs 100 times this video, that I give this a very strong. He truly is the greatest industrial consolidator of all time, as evidenced by his 8 multi-billion-dollar businesses he started. Not only a great consolidator, but also one of the greatest operations executives of all time, up there with Apple's Tim Cook. A bet in QXO is a bet on Brad Jacobs, which with his previous track record is one that I would like. For valuation, I give this a very strong. Currently, in my bear case scenario, for 2030, it grows from a $12 billion market cap to a $19 billion market cap. My bull case is a 4x stock return by 2030. For revenue and profit growth, I give this a strong. 8% net margins with mid-single-digit organic revenue growth rate and an industry ripe for disruption gives QXO the opportunity to become a major player in this industry. I do believe QXO will acquire their way into a $50 billion revenue business within the next decade from their $10 billion revenue rate today. For total addressable market, this is also very strong. $800 billion market in North America and Western Europe in a highly fragmented industry is the reason Brad Jacobs chose to pursue this industry over the dozens of others he brainstormed. For secular tailwinds, this is also a very strong. The 4 million shortage of homes will eventually need to be closed with accelerated construction, and in the meantime, the age in home inventory needs to be repaired. Infrastructure spending will also be a big budget item in the decades ahead. With that said, overall, I am a yes. Let's add QXO at this price to our portfolio. Strong leadership in a huge total addressable market with strong tailwinds all satisfied with QXO. What do you think, Dad? Are you as positive on QXO as I am?
Thank you, Scott, for that excellent presentation. Okay, I'd like to do my analysis for QXO, symbol QXO. Okay, for company fundamentals, it has no dividend. The beta is 2.25, which means it's 125% more volatile than the S&P 500. The market cap is 12 billion and earnings comes out November 12th. So for that, I'm neutral to negative because of the high beta and because of the dividend is 0. Okay, for the earnings history, the last 4 quarters, it's beat all 4 quarters. So that's a positive. Now for the financials, the net margin is 5%. The debt to equity is 0%, has no debt. And the PEG ratio is 2.25. So that's a little bit high for a industrial type of construction type company. But anyway, for that, I'm a neutral to positive. Okay, for the stock technicals, the moving average, the 50-day moving average is above the 200. 200 is slope and positive, and the price is below the 50-day, but a little bit above the 200-day. It's almost right at the 200-day, as you can see. It really has to hold that 200-day moving average. It can maybe go below it a little bit, but as long as it hugs it. But if it goes down, it's not a good sign. So anyway, the Bollinger Band, it's hugging the lower band, as you can see. And it's had average volatility since July 25 of 2025. Slow stochastic oscillator is 16, which means it's oversold. And what you want to wait for is it to pierce the 20 mark. Then we can see if we want to buy it or not. But anyway, the MACD is neutral, as is the unbalanced volume. Okay, for the analyst coverage, there is 1 strong sell, 2 sells, 1 hold, and 3 buys. And some of the analysts say 30 to 32. The institutional holdings, the percentage of the shares outstanding held by institutions is 92%, which is good because that way it dampens the volatility of the company. So because it's hard for institutions to sell a lot of stocks. So anyway, so that's a neutral. So overall, I'm a I think we could do a 1/3 position now, or if we want to wait, we can wait a little bit to see if it holds the 200-day moving average holds. So, but I like the company a lot in the midterm and in the long term, but it concerns me that it's hugging that's right just above the 200 days. So I would say in the short term, we could either buy a 1/3 position and then add later if it does go down. But the midterm, long term, I'm positive because of the CEO, Brad Jacobs. He really knows how to do mergers and acquisitions. So I feel very good about the CEO. So anyway, that's my take, Scott. So I turn it back to you.
Overall, we are both a yes for QXO to add to our long-term portfolio. It checks all the boxes for a phenomenal leader, a huge total addressable market, and strong secular tailwinds. With that said, thank you for watching. Please click a like and subscribe to keep up on our journey. Until next time, happy investing.